Hey, good morning. Dateline Jackson Hole, Wyoming. There are some big things happening that could have the effect that I want them to have on rates, or it could be the opposite again. We're going to talk about inflation, jobs, the Fed versus the Treasury. Inflation seems to be cooling. The last two inflation reports, CPI and PCE, came in below levels that would result in 2% year over year inflation. CPI came in at 0.01%. If you had 12 months of 0.01% inflation, that's 1.2% inflation. And the Fed wants us to be at 2. So we keep looking at this 12 months in the rearview mirror thing, but uh, it's encouraging. I hope it keeps happening. The oil thing is kind of throwing it for a loop, but the high oil prices may have reduced summertime vacations for a lot of people, so it could have been deflationary. We'll see. Jobs report very ugly. It was actually 27,000 jobs lost instead of 100 and some odd thousand gained, which was the expectation. When that happens, the Federal Reserve, that controls the Fed funds rate, looks at jobs numbers, unemployment, and inflation, and that forms their decision as to what they do with their interest rate. So that's kind of good news. Bad news is good news once again here. So, Jackson Hole, Wyoming, the yearly trip that the members of the Federal Reserve and influential and political people attend, sit around the campfire and tell ghost stories about what the worst thing could be in the economy and how to fix it. That happens this week. At the end of this week, we will hear from Fed Chair Kevin Warsh. His first two speeches have not been taken well by the market. The market is kind of not believing that the Fed is going to address inflation. So that has kept the bond market pushing the 10-year yield up, which has kept that 30-year fixed up higher when it was almost in the fives below this thing that happened in February. That was supposed to be over in February. Uh, the Treasury made a move this week and last week. Scott Bessent announced that they're going to use their money to do what the Fed used to do, and that is to purchase long term bonds at a level that results in the yield going up and the rate coming down. So buying all these bonds helps the rates come down, helps the 30-year fixed. They did it to the tune of announcing $4 billion that would happen to last through Election Day. Ironic. But the market didn't really blink at that. Nothing really happened. And so now, today, this morning, Monday, Scott Bessent, the Treasury Fed, and Will Ferrell character announced that they could spend up to $1 trillion purchasing those long term bonds to really move the levers that the Fed used to move during COVID and the financial crisis to keep rates artificially low. So they're really starting to put their hands on things, I think, to make rates look good before refinancing federal debt and before the midterm elections. It's just it is what it is, you know. Uh, all this could come to pass. Nothing could change. You know, I'm not going to say this is all guaranteed, but you might find conversations happening about this, and I want you to know more than the average other agent. So here's what we have here now. Get out of the way. It could hit mortgage rates with Treasury buybacks purchasing long term bonds, the 10-year yield coming down, the 10-year bond, and that affecting the 30-year fixed mortgage rate, getting that down from the upper sixes into the lower, hopefully. I'd love to see it. It's unfortunate the way they have to do it. Uh, but here's the piece that came out today. U.S. Treasury plans to spend up to $1 trillion to fund massive bond buybacks. We'll see what happens. You know, it could be all talk. It could be legitimate. It could really happen. It could be good. Hopefully it is. Thank you.